Anybody? Okay, sounds good. All right, so first off, there's going to be more vocab words that you guys need to write down. Okay, so I'm going to go ahead and type it here for you. All right, so the first one is ADR. Okay, ADR stands for average daily range. It is an indicator that tracks the average daily range. All right. Then we have book a profit. Closing all positions. So if you have 5 trades open and I tell you book your profits, that means close all your positions. Okay. Then we have Brinks trade. A type of trade that uses timing. I will go more into that. Right now, it's not far enough in the training to get into that one, but that's a type of confirmation to place a trade. Elgin, it's blurry. You have to switch it to HD or 720, 780 HP or something like that. You have to switch or change your visual settings. You can do that on the screen. I think it's 720. Change it to 720 and let me know when you finish it, when you changed it, so I can move on. If anybody else is having a blurry screen, the reason why is because you guys do not have it on high quality visuals. So you need to, on the screen that you're currently on, should look like a YouTube, like if you're watching a YouTube video, go to settings and then go to quality or something like that, and then change it to 720 HD or HP, however it has it. All right, good. Okay, so I'll go ahead and repeat it. ADR is average daily range, and it's an indicator we use to figure out what the average daily range is. Book a profit means closing all your positions. So if I tell you book all your profits or book your profits, you close all your positions. Brinks trade, a type of trade that uses timing. Once again, I'll go over that pretty soon into the trading. Oh, excuse me. Then we have candle spike. Candle spike is an aggressive candle to trigger stops. Okay. News is a good way, such as NFP. NFP many times the first 15-minute candle for NFP tends to leave a wick. Okay, it tends to leave a a very long wick, either hitting stops, inducing traders, causing panic, whatever it might be. But that's an example. And we have cross pairs. Cross pairs, what cross pairs are is basically, so you have uh, the, let's say, what's a good example? Okay, so you have the majors like the US dollar, the euro. Okay, so you have the majors, which are, I don't know, USD CAD. You have UJ could be a major, stuff like that. The main ones that are traded. Okay, now pairs like USD, Singapore, I think there's a pair like that. I don't know. USD, Nigerian, I don't know. Norwegian, I think Norwegian is a pair. NOK, I believe. So I think it's USD NOK. If there is, it's basically cross pairs. If I tell you they're working the cross pairs right now, that's why USD CAD is not moving. What I mean by that is they're not working the majors right now. They're working the other ones because they can't pay attention to all USD pairs. Some move more during a specific time and then slow down and start moving the other ones, which are the cross pairs, the non-major pairs. Okay, so if I tell you they're not working the majors right now, they're working the cross pairs. So then you go look at the pairs that are normally not traded, and you can see that they're moving those right now. They're paying attention to those. Okay, so that's what cross pairs are. Now you guys already know this. Extended stop hunt. All right, so what an extended stop hunt is, pretty self-explanatory. Price extended beyond normal okay, price extended beyond normal. So they didn't trap enough traders, so they keep going down or keep going up, trying to induce more traders, and then they're going to reverse. Okay, or they're going down and they didn't hit that many stop losses, so they're going down even more, so they can hit more stop losses. Excuse me. All right, so we have information, appears mainly on the high of the day. We have W formation, appears mainly on the low of the day. All right. We have the market maker trend, which is the real trend of the market. All right. All right, so you guys have these words down. So now I'm going to tell you guys where traps usually can happen. Okay, so the beginning, let me see, traps. Traps can usually happen at the beginning of the week. Beginning of the session. Beginning of the day. End of the week. End of the session. And end of the day. Okay, so what traps are is basically the market maker tries to trap you. Either they try to trap you on Friday to hold your positions over the weekend so that they can gap it and then it will hit your take profit, or it will hit your stop loss. Stuff like that, okay? So beginning of the session, market makers could try to trap you, away from their actual intentions, directional intention for that session. And another one is Asian session can or is normally used to trap traders, either consolidation or false moves. Okay, so Asian session I do not trade. I always teach people not to trade Asian session. Asian session tends to be used to trap traders. So it isn't a good thing to be trapped when the real money is in London and New York session. All right. Everybody has that down. If anybody wants me to go back, just let me know. Okay. Oh, man. Oh, 1 second. I wonder if I had a trade on that. I think I did. NZD CAD. I had bought down over here. I think I bought on this small green candle right there. I went down a bit, shot up. I had a feeling it was going to close this gap up here. I had my take profits up here. Let me see, I caught about 60 pips. I completely forgot I had this trade open. This is demo though, so it's not even that big of a deal, but practice is always good. The reason why it's demo is because currently I'm switching to a different broker. I'm going to FXCM, so I still haven't completed all the info for it yet. Hopefully go live by next week or so. All right, so let's see, 1 second. All right, so what we are going to discuss is, okay, what we are going to discuss is basically how the market maker moves. I want to show you guys how the market maker moves, how they think. It's a nice W formation. All right, so I'm going to show you guys why the market moves a certain way, why it 1 second, why it moves a certain way, what it means when it moves a specific way. That's what I'm going to show you guys, okay? So, oh, I do have trades open. Okay, so what I'm going to be going through is different formations, different types of traps, different things that will be used by the market maker to take your money, basically, okay? So this is the 15-minute chart. I'm going to hide this TDI. This is the 15-minute chart. So I'm just going to briefly go over different movements because each movement basically has, each formation has a name to it, okay? So the first one is going to be consolidation. All right. Let me look at a higher time frame. It'll be easier to see it from a higher time frame for this. Once again, if you guys have any questions, post them on wherever you got the link from. Okay. All right, let me use much better. Okay, so let's start here. All right, so you see this area here. Okay, let me change it to different colors, a little too bright. Okay, so this area here, this is called consolidation. Now on the first video, what I told you guys, when I told you guys to write the words down, the vocab words from the first video, I told you guys one of the words was consolidation. Okay, what that means is the market is moving sideways. The market doesn't have a true direction. It's not going up or down. It's just moving sideways. Excuse me. This is an example. Market is moving sideways here. It's not really going a true direction. It's just bouncing up and down, bouncing up and down. Okay, and then eventually, yeah, it does drop. All right, so that's an example of consolidation. Let me show you another one. This is an example. That's consolidation here. Okay, so what is consolidation? The market, yeah, it's moving sideways. But what is consolidation in market maker terms? What exactly is the market maker doing? Why is the market maker making the charts go sideways? Why is it making the market go sideways? And the market maker always has a trick up his sleeve. There's a reason why he's moving the market sideways. Okay, so 1 second. Okay, so the reason why the market maker is moving the market sideways is because he is preparing for either a big move, he's trapping impatient traders, and he's getting ready to take people's money. Those are the main reasons why consolidation happens in the market, because the market maker is trying to do something. So, for example, you take a trade. All right, I have a question here. Can trading on a daily chart be affected by the market maker moves? So, let's see. Can trading on a daily chart be affected by the market maker moves? I'm sorry, I'm kind of off today. I'm not sure if you guys noticed, but trading on a daily chart be affected by the market? Yes, on every time frame, the market maker basically influences the market on every single time frame, whether it is long term or short term. Okay, normally what happens is they focus, they know where they're going long term, so they try to take your money short term right then and there, but know its true direction long term. Okay, so the market maker already knows where he's going long term. The thing that he's focused on mainly is short term, on the 15-minute chart, 30-minute chart. What exactly is going to happen now? How am I going to move now? Because it's easy to predict. Let's say if you're starting your own business, okay, I want to recruit 1,000 people. I want to recruit 1,000 customers, basically get 1,000 customers by the end of this year. Okay, so that's a long-term goal. But the short-term goal is going to help you reach that long-term goal. So what is it that you're doing now to get you to that long-term goal? So you're focused on what's going on now, and as each day goes by, eventually it'll hit your long-term goal, your yearly goal. So that's how the market maker thinks. He knows where he's truly going long-term, but he's focused on taking your money now. All right, so it does affect it, yes. All right, so I hope I answered your question. All right, so consolidation, moving the market sideways because the market maker is trapping impatient traders about to break out or make a big move and about to take people's money. Okay, so as you can see here, they were moving sideways, trapping impatient traders. The impatient traders were thinking, oh, the market's not moving yet. I want to place a trade already. I want to make money. I know it shot up over here. That means it's not going to go back down over here because they already, the trend is changing. There's so much movement up now in the past 3 hours that it's not going to go back down. I think it's going to keep going up. So they see that the market moves down a little bit, but they're like, oh, it's okay. It's okay. It's just a little bit. You know what? I'm just going to place another buy right here. Okay, consolidation. I'm just going to place another buy right here because I know it's going to move up and I just don't want to wait. So maybe this is the best placement I'm going to get. Okay, so what they do is that's how they trap the impatient traders. I want to place a trade now. I want to place a trade now. I can't wait. The market maker does not move based off your convenience and your time. He is not going to move. He's not going to think that, oh, you know what, Bob over here, he has to work at 8 o'clock, so I'm going to go ahead and move the market quickly before he has to go. No, he doesn't care. He does not care whether you have to go to work, whether you have to go pick up your kids, nothing, okay? He doesn't go based off of you. He goes based off of, okay, I'm going to consolidate now, and I'm going to trap traders. But I need enough traders to be trapped so I can move the market again so I can make more money. That's how they think. They need to trap enough traders so that they can make a substantial amount of money to be able to move the market and take everybody's money. So here, that's what they did. They consolidated for about a day and a half or so, maybe a day. They consolidated for like a day. And after that, they made their move. They trapped enough traders after that day, and they made their move because people didn't want to wait, and they took people's money. Okay, so simple as that. That's how consolidation works. That's how they take your money. Okay. All right. So let's see. Now, one thing that I'm going to teach you guys now is I do not like people to trade when the market is choppy. Now, I'm going to show you what I mean by that. All right, so choppiness, all right? I'm going to show you an example, hopefully. There's a pretty good example somewhere. Okay, here, for example. This is what I consider choppy, this whole thing. It's kind of moving sideways, but kind of isn't. It's kind of a mix of both. It's ranging, okay? At the top of the box is hitting the top, hitting the bottom, just bouncing back and forth, right? That's consolidation. But it's also choppy. It looks ugly. Like, what am I supposed to do with this? There's wicks everywhere. It's like, it looks like indecision. The market doesn't even know where it wants to go. Maybe the market maker is drunk or something. I don't know. But this, you do not trade. So get the picture in your head. You will never, ever trade this, nor will I ever teach you to trade this. Wicks everywhere, candles going sideways, that you will not trade, okay? All right, so I showed you guys consolidation. I'm Now I will show you guys trap days. Friday, Sunday trap days, beginning session. All right, so let's see, what's today? Tuesday. So on the 1st was Sunday. All right, so let me show you guys Friday. No, bad example. Friday consolidated. That's considered a trap, but I want to show you guys an actual trap. So here, let me just show you guys anyways. Friday is this one here. So look what it did. It basically, it was just moving sideways for like about a day and a half. No actual direction, just moving sideways. Okay. You can trap, the market makers can trap traders like that as well. So this is considered a trap, but it's not the one I wanted to show you guys, but this is still considered a trap. Okay. Consolidation on a Friday, making people hold trades over the weekend. All right. So let me show you guys what I actually wanted to show you guys. Okay, right here. All right, so this right here shows you, so I'm going to draw a red line going down. Okay, make it a little more thick so you guys can see. All right, so this red line here shows you from, let's see, from a Friday till, where's the new week? 7, 8. Okay. Okay, here. All right, so here, the overall market is moving down over here, right? And the overall picture, it's moving down. All right, so now it comes to a Friday. Now, if you look at the times and the dates down here, it shows you the date, 13th of April, 14th, 15th. Okay, so the 18th or the 15th of April, this here, this is Friday. Okay, so I want you to look at the overall trend of the week. It's down. Okay, now when it comes to Friday, what did they do? Friday is this one here. What did they do? They shot up. They trapped traders. As soon as the market opened on Friday, they started to move up. They trapped all of the people that were selling. They trapped everybody that was selling. They randomly just decided to shoot up. They trapped enough traders for, let's see, this was going down for about 2 weeks. Okay, so when it comes to this Friday, look what happened. Shot up, trapped all of those that were selling. Okay, now I want to look at the previous Friday. Their overall trend was down, right? Down, down. It was going down for basically the whole week. And what happened? This is Friday. Actually, sorry. This is Friday. It shot down, induced more short traders. Sunday, it shot up. When it shot up Sunday, Sunday's also a trap day. Friday and Sunday. Sunday, it went long for almost the whole day. Then it just decided to go down. So it trapped traders that were going long that were going short all of last week. and then it shot up opening of the new week, trapping a lot of traders that were going short, taking everybody's money because they're thinking, oh, it's probably going to go up for the rest of the week, so I'm just going to cut my losses. And what did it do after? It spiked up, scared traders. They took out their positions, their short positions, because of the spike up. Then it decided to go down once it took enough people's money. Then it went down until the next Friday on the 15th. Then it shot up. Took everybody that was selling again. All right. So this one's Friday. Now look. This here is basically Sunday. What happened Sunday? This is Friday. This is Sunday. They trapped traders that were going long on Friday because what do they do Friday and Sunday? They trap traders. Where did they trap traders on Friday? They trapped them buying. They trapped those that were buying. Sunday, they took everybody's money that held their trades over for the weekend. They pushed up long. They had few candle spikes here that were long, which convinced more traders, oh, I'm going to buy more. I'm going to buy more, which makes it more money that the market makers can take away from them. So what do? Here they made an M formation and just dropped it, took everybody's money. This is actually 3 hits to the high. I'm going to be teaching you guys that, but this is 3 hits to the high, dropped the market, took everybody's money. Everybody's money. Everybody except for my students. I'm sorry. My students, they knew what was coming. So if you're not my student, you lost, basically. So this is what they did. They made a formation here that I'm going to teach you guys. 3 hits. Oh, lost it. 3 hits to the high, dropped it. So what did they do in a span of 2 to 3 weeks? They made the trend short. They trapped those that were going short by making it go long on a Friday, randomly just shot straight up. People that were on sales, they decided to close positions because they don't want to lose any more money. They decided to take their losses. So then instead they go for buys. They close their sell positions, they go for buys. So when it opens up on Sunday, it opens up with huge candle spikes going long, inducing more traders to buy. So when it does that, when it induces more traders to buy on a trap day, they can basically, you can picture them, oh, they're probably trapping buyers so they can sell. What did they do here? They trapped the buyers so they can sell to make enough money from the people buying. So here's what they did. Sunday, they trapped buyers, shot it down for the rest of the week. They shot it down 350 pips or so. That's how it works for trap days. That's normally what happens. You guys can see the overall picture, just practice seeing what happens Friday and Sunday, how they trap traders, induce them to go one way on Friday so they can trap themselves over the weekend. Sunday, they might induce them to go or trade the same way as they moved on Friday, or they can just move the opposite direction, trapping those that held their trade over the weekend, based off of the direction on Friday. So that's how it typically works. It's very, very simple, extremely simple. So that's the mentality of a market maker. Okay. Um, Now let's look at sessions. Let me bring up a different pair. If you guys have any questions, don't hesitate to ask. Let me actually do it this way. No. No. Okay, so let's see here. So, beginning of session. One of the traps that I was telling you guys was beginning of session as well. So let's see here. Beginning of London session with this, it's this peach looking box, okay? Peach colored box. So in the beginning of the session, for the first 45 minutes or so, the market is moving long. Then it drops. So here's the trap in the beginning of the session. It's looking like a buy, but then it drops, okay? Now, that's typically what could happen. I would say to expect that. Now look at here for Asian session. It's just moving sideways most of the time. It doesn't have a true direction, so it's trapping traders for Asian session. You can expect that. Look at Asian session, moving sideways. All right, and then London session didn't really move much. The Asian session looks pretty ugly. London session fakes people to sell, then goes long for the rest of the session. Stuff like that. It's pretty simple. Here in Asian session, they actually moved, and then London session looks like they just consolidated. Didn't really look like a movement. So New York session, they went short. Then they rose for the rest of New York session. Consolidation, Asian session. I want you guys to take a look at dead gap right before the blue box. Dead gap. You guys don't trade that because I teach you guys not to trade that. It's just consolidating. 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 Here moved a bit probably because there was news. Consolidating. Consolidating. That's basically it. Consolidating. Once again, I mean, I can keep going on and on and on, but that's why I tell you guys not to trade dead gap. It's because there's no market makers on duty. There's nobody clocked in for you to trade against or trade with. So there's no formations or anything that are going to be showed to you. Okay, so that's basically it. I taught you guys some new vocabulary words that you guys are going to be using. I taught you guys the market maker mentality, at least consolidation wise. I taught you guys choppy market, how it's not to trade during choppiness, trap days, trap sessions. That's basically it, guys. There isn't really much more to teaching you other than the formations and how the market makers use formations to trap traders. So I'm going to be teaching you guys that. Hopefully tomorrow I can show you guys an intro. All right, but other than that, that's basically it, guys. So I will go ahead and let you guys go. I hope you guys learned stuff. If you guys have any questions, go ahead and message me. Do not hesitate to ask anything. No question is a stupid question. Okay? So I will see you guys tomorrow, same time, 7 o'clock Pacific, 10 o'clock Eastern. You guys know, you guys are already here. So, all right. So I will see you guys then. You guys have a good night.